Hi folks, and welcome back to Meaningful Money. Okay, here I am in my kitchen. It's not the most exotic of backgrounds, but it's clean and tidy. I hope you'll agree. It's always clean and tidy, but I double checked it because my wife would have killed me if I'd have shot a video in here and it wasn't absolutely perfect. So sorry it's not quite as exotic as normal, but it's throwing it down raining outside. It's supposed to be raining for the next 5 days pretty much, so I need to get some videos up, so I'm stuck inside. I'm sure you don't mind. Now, we've been talking about retirement options, and we're going to carry on that now. Last time we talked about doing nothing, deferring taking your pension, and the pros and cons of that. So now we're going to talk about lifetime annuities. It's the sort of default, bog standard option for converting your pension fund into an income, okay? So as ever, before we get into the meat of that, and my good friends down here in the bottom right, that's Seven Investment Management, a superb firm of investment managers down in London. They sponsor Meaningful Money, and I'm ever so grateful to them for doing so. So thank you very much, chaps. Right, lifetime annuities. We have covered these before. I can't for the life of me remember the episode number. Should have written that down, so perhaps I'll put it up here so that you can go back and check that one. But very simply and in précis, an annuity is where you hand over your pension fund to an insurance company, and in return they give you an income for life. Right, so far so simple. Except it's not, never is it? It's a one-off, irreversible transaction. Once you've made your choices, you're stuck with it for life. But that can be a good thing. I'll come back to that in a minute. You need to remember something called the open market option, which simply means that if you've saved up over the years in your pension plan with, say, Standard Life or Aviva or Legal & General or whoever, you don't have to buy your annuity with that same company. In fact, it's always worth shopping around for the company who gives you the best rate of annuity for the size of your fund, okay? And it's also worth bearing in mind that if you're in poor health, even if it's very mild poor health, like just having high blood pressure, or if you're a smoker, it's worth shopping around for something called an impaired life annuity. Logic simply says that if you're going to live shorter time than somebody in good health, then you will be paid more while you are alive. That's straightforward enough. So you hand over your fund in return for an income. You've got some quick choices though, which I'm going to cover very quickly because I've covered them before. One is whether you choose a minimum payment period, sometimes called a guarantee period. So if you choose a 10-year guarantee period and die after 5 years, it'll pay for the balance of the 10 years. It's a minimum period. If you live for 40 years, it'll pay for 40. Right? It's a minimum period. That's called your guarantee period. Whether you choose a level or escalating, going up every year, pension, whether you opt for a single life pension or a joint one, so if you have a spouse who's financially dependent on you, you might want to provide for him or her. The mode of payment, so whether it's monthly, half yearly, yearly, termly or whatever, and whether it's in advance or arrears, you've got that choice as well. Excuse me, a little bit of windy pops there. And finally, you can build in something called value protection, which is, it pays you a bit of a lump sum back if you die in the early years. All of these options cost you though, and they will reduce the income payable. So let's look at pros and cons of annuities. I'm going to scooch just a little bit so I can bring in a graphic. So pros first, and they are, firstly, you can access your tax-free cash. So whatever your fund is, when you hit retirement, you can take 1/4 of it as a tax-free lump sum and drop that in your bank account to do whatever you want with. The rest has to buy you an income. So you've got access to your tax-free cash if you buy an annuity. The income is guaranteed, really important for a lot of people, right? So it's guaranteed for life, which means you don't have to monitor it anymore. There's no investments you have to look after and keep an eye on. And fourthly, the longevity risk, which is something we talked about in the risks video a few back, the longevity risk is transferred to the life company. So, as far as you're concerned, you obviously want to live as long as you can. But if you live really, really, really long, that's not your problem because the insurance company have guaranteed to pay you for the rest of your life. So longevity risk is passed to the life company. You don't have to worry about that. So that's the pros. Moving on to the cons, it may be the case that the annuity rate isn't favourable right now. So that's the amount of income you get per £1,000 worth of fund. you know, we're at record annuity rates as I'm recording this, which is December 2011. Doesn't look like they're going up anytime soon either, but they may do. It just might be that now is not a good time to choose an annuity, but who knows when a good time is going to be. I'm afraid I can't answer that question. It's both a pro and a con. Your income is fixed for life, right? So you can't change it should your circumstances require that. You know, so you can't say, well, actually, it's not quite enough now. 10 years down the line, can I have a bit more money? The answer is no, it's fixed for life. If you choose for a level annuity rather than an indexed one, which goes up every year, then inflation will reduce the amount of buying power your income has. And then finally, if you die early, annuities are a really bad deal. So if you hand over a £100,000 fund in return for, I don't know, £6,000 a year income, and then die after a year, that's a pretty rubbish deal. Another argument in favour of guarantee periods and other sort of value protection. So those are the pros and cons. Now, who might opt for an annuity? Oh, sorry, kick the chair there. Who might opt for an annuity? People who are risk averse. If you don't like risk at all, if you don't want any investment issues around your retirement income, an annuity is possibly for you. If your pension is quite small, you know, there's not many of us who have pensions more than 50,000. I say not many of us, mine isn't there yet, by any means. But most people have small-ish pension funds, and some of the other options, which I'm going to come to in future videos, won't be open to you, just because they're going to be prohibitive because of the costs of them and things like that. And those people who want the rest of their life mapped out, that you just want to make a decision now and it's done, and you know you never have to think about it again, then an annuity is quite possibly for you. As ever, you must seek advice on these things. It's really important, but that's the sort of pros and cons and who might choose an annuity. Okay, so next time we're going to look at something slightly different, but also very much the same. I'll explain all next time. It's something called a fixed term annuity. So join me next time for that, and thank you from my kitchen. Thank you for watching, and I'll see you next time.